Welcome XRP and XLM fans. We're going to dive into an exciting document which connects a couple of partnerships with Ripple and Stellar. This document is very informative, explaining the world of blockchain and how banks are going to be adopting it and tokenizing and more. Also, I want to clear up some information that has been going around. We're going to get to the bottom of this so investors have a better understanding of what XRP is going to actually be used for. It's not going to be used for the bulk of cross-border payments like the majority of people thought, but there is still good news. Also, we're going to hear from a knowledgeable person in Fintech, CEO Michael Cabanera from Ibanera. If you're new to the channel, please subscribe so you can stay up to date, share with friends and family, because the more people that learn about XRP and XLM and other great assets talked about on this channel, the more people can invest. Let's go ahead and dive in. One of the many reasons I love using D'CENT Wallet is the fact they offer different products. They offer different wallet types. Unlike other wallet companies, they give you more options. First, I want to start off with the card wallet. The D'CENT all-in-one card wallet is your complete solution for your crypto and NFTs, and it's the size of a credit card, so it's nice and sleek and can easily fit in your pocket. You can secure crypto and NFTs offline with its secured chip. The card wallet offers ultimate convenience. All-in-one card wallet connects to your phone via NFC to manage your crypto assets on the go. I personally like to hold the majority of my assets on the hardware wallet, and I keep a little bit on my card wallet. The biometric wallet is the flagship of D'CENT Wallet. It is my personal favorite. It's a hardware wallet that connects directly through your Bluetooth to your phone. You can hold over 2,000 different types of crypto assets. It's incredible. It uses a high-grade, secure EAL5 chip that's used by top financial industries around the world because of its high security. You can safely store not only crypto assets, but also NFTs. You can access marketplaces, you can swap, you can purchase, you can also exchange. It's pretty awesome, directly and safely convenient from the wallet. Now, if you're interested in getting your hands on either the hardware wallet or the card wallet, or maybe both, or if you want to check out the two-package hardware wallet deal, there's incredible, too good to be true discounts in the description below. Check it out and enjoy. Tokenizing banking. Tokenization of traditional assets holds potential to transform banking. Banks are increasingly adopting blockchain technology to bring the technological benefits of tokenization without the volatility, speculation, and risk associated with cryptocurrencies. Most early blockchain innovation was focused outside of the regulated banking sector in novel cryptocurrency markets. These markets provided testing grounds that have demonstrated the efficiency and stability blockchain technology can deliver, but we have yet to deliver real-world value. More recently, banks and other regulated financial institutions are leveraging blockchain infrastructure to facilitate real-world activity, such as helping small businesses invest and grow or helping families purchase homes. These projects have demonstrated that blockchain has the potential to create more efficient infrastructure, driving down cost, facilitate the creation of new markets that bring new funding models to lower the cost of credit, empower banks to offer new products to better serve customers, and allow customers to embed banking services into their product, creating a seamless experience that deepens relationships. While investment has primarily been at the largest institutions, it is critical that community banks understand how blockchain will impact the future of banking. Why blockchain? At its core, blockchain is a shared database that is constantly updated by the participants in the network. Unlike existing databases in banking, which are proprietary and siloed, all participants in a blockchain network see the same updates in real time. This allows multiple parties to collaborate in real time. This creates a number of advantages over traditional database technologies: faster, cheaper, safer payments. As a shared system of record, blockchain can facilitate the near real-time transfer of value. This allows for rapid transactions at minimal cost. Today, many frictions in payments are not due to technological limitations, but the need to coordinate between separate systems. Blockchain can break down the silos between these systems by allowing both the asset and the payment to be recorded in the same system of record. This real-time reconciliation between systems can reduce time needed to complete a transaction and reduce the risk of fraudulent transactions by providing a clear line of sight into all aspects of a transaction. So we have programmable payments. Blockchain can integrate smart contracts, enabling banks to automate the execution of complex payments based on real-world conditions. For example, smart contracts could be used to automate the payments process associated with buying a home. Today, a buyer sends money to escrow, and an escrow agent calls individual banks and confirms wires to all the various parties that participated in the transaction. With a smart contract, we can deliver each payment to the right party the minute a contract is signed. Also, atomic settlement. Blockchain adds additional value when used as a system of record for other traditional banking assets like loans. Today, banking infrastructure is a system of siloed proprietary databases. These silos create friction. When a transaction requires moving assets in multiple systems at the same time, a buyer will not release funds until they are sure the asset is moved in a separate system of record. Blockchain allows for both payments and assets to be recorded on the same system of record. This allows a buyer to trade their dollars for assets in real time without a settlement risk because the transfer of money and the purchase asset move in the same transaction. Incorporating atomic settlement into traditional banking assets makes it easier to buy and sell those assets. By making these assets more liquid, we add new funding options that lower costs of credit, expanding access to affordable financial products. Collaboration among community banks. Blockchain also has potential to ensure the continued competitiveness of community banks. A key force driving industry consolidation is the large fixed cost of technology investments. Large institutions have better ability to spread these investments over a large customer base. As shared infrastructure, blockchain changes this equation, promoting a focus on value of individual customer relationships. This is similar to cloud technology, which help level the playing field for small businesses by offering flexible and scalable infrastructure. Industry adoption. This is what we are all here for. Industry adoption. In recent years, banks have ramped up investment in blockchain projects, with many launching tests and some bringing final products to the market. Unlike crypto products, these services closely resemble traditional financial services, offering, in many cases, customers may never know that blockchain is being used to power the experience. Too often, blockchain is sold as a silver bullet that can solve any problem. Like any technology, it has strengths and weaknesses. It is a tool that, when used correctly, can have a huge impact. However, there is a tendency to see every problem as a nail when you are holding a hammer. The most successful project in this space maintained a laser focus on where blockchain adds unique value. We have found that programs with the following needs are most likely to benefit from the application of blockchain. You have collaboration, break down the barriers between institutions and asset classes, allowing for real-time collaboration, programmability, automate payments or asset movements based on certain real-world conditions, atomic settlement, facilitate the purchase the sales of assets without incurring counterparty risk. Now check out these different projects, and I just want to connect some dots here, especially with Ripple and Stellar. This is awesome for Ripple and Stellar fans. You got Citi, you also have MasterCard, and I want to connect some dots here. Last year, it was announced that Ripple partnered with MasterCard for CBDCs. Now, this is connecting a dot with Citi. Citigroup reviews partnership with crypto custodian Medico. Ripple Labs bought Medico for $250 million a while back, now pointing to Stellar. Stellar MasterCard teams up with Stellar X, acquired by CoinSquare, Satoshi Pay grant program. All right, keep in mind that we've even heard from Brad Garlinghouse, we've heard from leaders in Stellar that, just as this document was stating, that the old way of handling these transactions, it was a siloed world. Now, with interoperability, a lot of these payment networks, especially dealing with the blockchain, they're going to interoperate with major networks like the XRP Ledger or the Stellar network and so on. So let's dive more into some of these current projects. You also, so right now we have the USDF alongside 11 large banks, regulated settlement network. 11 large financial institutions came together to test interoperable tokenized deposits on a shared ledger. They found that the use of a shared ledger added operational efficiencies, particularly in cross-border transactions, allowing for the creation of a dollar payment rail that is available globally 24/7, 365. What does that sound like? The second phase of testing is exploring the use of tokenized deposit to facilitate the purchase of tokenized assets such as treasuries or securities. Stellar right now has been tokenizing a lot of treasuries, and I think that's just a test run of what's to come. Here we have Citi Token Services. Citi has tested live transactions for tokenized deposits. Their platform is designed for institutional clients and initially targets trade finance applications and global payments. JP Morgan Onyx. You also have MasterCard Multi-Token Network. MasterCard has piloted its multi-token network, or MTN rather, as a way to create interoperable network rules that facilitate transactions within the digital asset ecosystem. Their early focus has been on enabling tokenized deposit products. They also have Finality, a UK-based payments network enabling tokenized deposits. Finality recently raised $95 million from Goldman Sachs, BNP, DCC, Nomura, and Euroclear. It has received approval from the Bank of England to operate a dedicated master account to facilitate final settlement for transactions. All right, we're going to listen to an IBS Intelligence Global Fintech Perspectives podcast. We're going to get a very good idea of what is coming out of this cross-border payment revolution, the future of cross-border payments, rather. Now, there is a lot of misinformation that's going around, so I'm here to clear up some of that information. People put a lot of money into these assets, so I'm sure they're going to want to know the absolute truth. There's still a lot of great things going on with XRP, which I'm going to cover. I'm going to dive into an article here in just a moment, but the fact is, when it comes to the bulk of cross-border liquidity, they're not going to be using XRP. They're going to be using stablecoins. And in fact, I want to show you an article as well that shows that maybe XRP was the first intention, but now with stablecoins being created and thought of, it's going to be used for the majority of cross-border payments, but XRP will still be needed as a bridge asset. There's a lot of people out there spreading all kinds of information. Let me give you an example. BRICS adopting XRP for cross-border payments is complete nonsense. I think I've already debunked that in a previous video. I've also gone over on the price targets. The price ranges that some of these people are talking about, content creators, it's ridiculous. So now that's not to say that XRP will not have a potential high price, but we're going to have to see how the market plays out, how regulations play out, how investors play out. So let's go ahead and dive into some of these articles so we connect some dots and then listen to that. I'm going to end with this podcast. All right, let's first dive into this article from Crypto Adventure. We're going to dive into this old document from the World Bank. It's a few years old already, talking about XRP and XLM, I want to add, as being stablecoin for instant transactions, but a lot has changed. You know, there's speculation about it being a high stable price or a slightly fluctuating price, kind of like how we see with gold. But a lot of things have changed. Okay, so Ripple, XRP, and Stellar XLM are two cryptos that can transform cross-border funds transfers, unlocking value through fast and efficient transactions, according to a World Bank report that recently resurfaced. The report, authored in 2021, dived into advent of CBDCs and their role in payments between countries. It looked at the various CBDC cross-border projects that were ongoing at the time. The World Bank noted that XRP Ledger could process transactions involving any currency, allowing users to transact crypto and fiat currencies through near-instant transactions that cost pennies in fees. The existing global system takes over 3 days to settle cross-border transactions and is quite costly. A separate World Bank report revealed that in some regions like Sub-Saharan Africa, users part with 8% of the transferred value in fees. Critically, the World Bank report described XRP as a cross-border stablecoin. This is a big part why users revisited it, as Ripple announced that it will launch its own stablecoin, XRP Ledger. As Crypto News Flash reported, the new stablecoin is Ripple's response to users who have been reportedly requesting one for the longest time. They state that our view is having pools of liquidity that are native to the XRP Ledger. They complement and help grow the XRP ecosystem, Garlinghouse told CNBC in an interview. So right here, with the launch of the new stablecoin, XRP is unlikely ever to be utilized as a payment stablecoin as envisioned by the World Bank. Now, just as I stated, there is still great news for XRP. Let's check this out. Ripple explores new horizons with RLUSD stablecoin and potential XRP ETF. So Ripple's President Monica Long, in an interview with Frank Shapiro on The Scoop, elaborated on the company's plan to launch a US dollar stablecoin, RLUSD, and also discussed the potential for an XRP ETF. This follows a significant regulatory clarity gained from the U.S. courts last July concerning XRP status, not as a security but as a commodity, which has stimulated new business opportunities for Ripple in the U.S. Long explained that the decision to introduce a stablecoin is driven by the needs of Ripple existing payment clients and banks, while stressing the role of stablecoins in facilitating efficient and transparent transaction. So the more I'm looking into this is still not a bad thing for XRP. She explained that the USD stablecoin aims to optimize efficiency in major payment corridors with abundant liquidity, such as USD to EUR transactions. In contrast, XRP will continue to serve as a bridge asset right there, particularly in more costly and less liquid payment corridors. So it's still great news for XRP holders. I just wanted to clear up information so you know exactly what is going on. Will XRP be used for the bulk of liquidity around the world? Probably not. But is it still going to be used in corridors where they for high costly corridors and where they need that extra liquidity? That's what Monica Long, the president, stated. So if you're an XRP investor, probably still a good hold. Now, but some of these price ranges that some of these people are talking about is kind of ridiculous. But again, XRP could be a high price depending upon how the market plays out, regulations, and the demand and investment. So we'll have to see. Let's go ahead and go to this podcast so we can get a better understanding of how this whole landscape is unfolding.
Talking about cross-border transactions and the role of digital assets. Michael, is it too early to say how the digitization of payments is affecting business? We know it's going to, but is it doing so already?
It is. It's been happening for years, but I think that we're now at the point where there's a lot of momentum, and because of that, there's investment coming in from the institutions to make this a priority in money and how finance is happening and how commerce is happening domestically and cross-border.
I'm going to try and put you on the spot. What you're talking about is how people are adopting the digital payments infrastructure. But what kind of effect is that having on business in general and will have on business? Will people be able to do things faster? Will people be able to do more business? Is it going to be an advantage?
It's going to be an advantage because anytime there's technological innovations, it's going to make things cheaper and faster. And what we're seeing is that businesses are now investing to adopt that technology and innovate new technologies into the digitization of payments to the point where businesses have much more control of how they manage their payments, how they receive payments, collect payments. And they're doing so with less intermediaries. With blockchain and Web3, that updated architecture that we all sit on to make these payments, the businesses are adopting them directly. So they're not relying as much on the traditional banking networks to facilitate as intermediaries and essentially increase the rates.
Well, one thing all this does is it takes control out of the hands of the regulators. There is no level playing field in cross-border payments in particular. Regulation is complex, differs from jurisdiction to jurisdiction. You have different hoops to jump through depending on where you are in the world and where you want to do business in the world. And you're taking power away from the regulators. Are they going to sit still for that?
That's a good question. And I think that, as a business going to these other markets that are foreign to where you're starting, you have to consider those local regulations. And when you're taking payments from a consumer in a foreign jurisdiction, you have to make sure you're compliant in that jurisdiction before you're active. But from a regulator perspective, it's important to create these frameworks, because if they don't, they're going to be left behind, and they're not going to allow the market participants to go into their market if they're not creating an environment that lets them. This is one of the situations that digitization of payments and blockchain, it allows businesses to go directly to consumer or consumer to consumer And if there's no framework, then people are going to find a way around it like they've always had forever. So it's better for regulators to actually participate and create framework to invite businesses, because then everybody benefits. And the great thing about this is that with blockchain digitization of payments, it's smart payments, it's programmable payments. It's easier to monetize from a authority perspective and also from consumer perspective than traditional finance.
You answered part of this next question, I guess, with what you've just been saying about blockchain, but I'm going to ask it anyway. What are the innovations that can create borderless payments? Blockchain obviously is one. What are the others?
Blockchain, of course, but that is the underlying technology that's going to allow, that's the medium for exchange, essentially. And the technology behind that will use blockchain is going to be digital assets. But in my opinion, it's going to be real world tokenization of assets as NFTs and stablecoins. Regardless of cryptocurrencies and a lot of different tokens for different initiatives, use cases, at the end of the day, it's really going to be stablecoins of the native currencies in the different countries, because it allows regular payments to move across peer-to-peer on blockchain. And the NFTs allow assets other than currency to transfer ownership.
What you're telling me sounds suspiciously like a 21st century version of the medieval Templars taking in credits on one side of the table in one country and issuing letters on the other side of the table in another country. But that may just be my own twisted imagination.
I think that's exactly what it is. I guess the Templar model is the first borderless payment processing. But the main difference here is that it allows peer-to-peer. It's a decentralized network. And so it increases speed of movement and engagement, because consumers can engage directly with consumers on blockchain using that same model of commerce. So I think this is just the same old model, but with newer technology.
Can we just underline the situation as it pertains to the security of payments and explain how blockchain ensures that? Because the one thing that I think of when I think about faster payments, instant payments, cross-border payments, is how secure is this going to be? Because the faster it happens, the more chance I feel I've got of losing my money.
There's a couple of things there. So if this is a peer-to-peer payment, you can have peer-to-peer payments across centralized finance, and that exists today, and it has for 2 decades. With blockchain, it's faster and more agile. However, if you're going peer-to-peer, directly to consumer, you lack an intermediary to say, okay, this is fraud, or we need to do a refund, or products weren't delivered. So there's going to be a model where it's peer-to-peer as a DeFi, but also peer-to-peer CeFi. Now, the example I just gave, it's no different than when somebody paying cash for something. You still lack an intermediary. Of course, there's legal recourse if you ever need that. But peer-to-peer with the CeFi networks, you still have that authority. If you need to do a chargeback, you would call your card, Visa, MasterCard, issuing bank, and you would do a chargeback. If you're doing a peer-to-peer payment on blockchain, both a CeFi network, you have a centralized authority for dispute resolution. So it's a question of how do you develop dispute resolution CeFi, but what are the recourses if you are wronged on a DeFi transaction? You must know who the other party is in advance. So if you need recourse, you follow the existing legal framework to have recourse.
There is an issue that we do need to look at when we talk about cross-border payments and what happens in other countries, and that's financial inclusion. So what does all this mean for financial inclusion? How can we bring more people with us?
That's a good question. And there's a few things there. So financial inclusion requires identification of risk, because a lot of the emerging countries don't have the same standards of compliance, AML, that some of the we see in US or Europe or places like Singapore. It's a very robust compliance standard. So it's a matter of the networks you're dealing with, and to have a compliance standard where you can identify that customer. And how do you identify it? And how do you look at the actual risk rather than perceived risk of, say, a given country that may not be up to standards. We have to look at the risk of the individual, and that can be done today. There's lots of different ways to do KYC remotely, tokenize that KYC, and create a digital identity credential so that this wallet on blockchain belongs to this person, and we know who this person is, we know who they're acting with, and they're just trying to buy goods, buy services, and do business as usual. When that's in place and blockchain's in place, then those people, as they have mobile devices, essentially your blockchain wallet becomes your bank account in essence. So you can conduct business no matter where in the world you are, because digital assets are not limited by borders. You can commerce with anybody in the world. You can buy, sell, cross-border almost instantly. So as long as the KYC aspect's in place and you know who you're dealing with, it makes the financial inclusion much easier.
Finally, then, let's talk a little bit about Ibanera itself. What is your company's role in creating this future you've been describing?
Ibanera is a banking and payments fintech platform. And we're a regulated financial institution in a number of countries. And we've built our own technology, both Web 2 and Web 3. And our goal is to build the next generation of technology to make things Web 2, Web 3 interoperable for payments and create a network for fiat API connectivity. So that way, businesses, fintechs, other financial institutions have a way to easily participate in this new technology, in this new framework. Ibanera is really on a mission to create the back-end network to empower all these other fintechs to make it easier as a plug-and-play model.
Michael Carbonara, Chief Executive Officer of Ibanera, thank you very much.